many of you have gone through the slides? The slides for tutorial. Have you gone through it? Oh yes. Okay. This class will be the first and the last that I will technically be teaching, like try to teach something. So as from the next tutorial, we're going to be doing something more of discussion. Alright, so we're going to be discussing more between and amongst ourselves, alright, so that everybody can be engaged and we can all learn something from one another, alright, so that's that. And to facilitate that, to make that more engaging, more rewarding for each and every one of us, I want each of us to put a question here, alright, or a topic you want us to discuss in the tutorial, right? So for example, our next tutorial is going to be in the next 3 weeks, right, because of Chinese New Year break, right? So next week no tutorial, Chinese New Year break, and then the following week after Chinese New Year break will be our next tutorial, right? So then you can input okay, you can just here input I want us to discuss this topic, something like that, or I have this question, so you put it there so that everybody can see it and everybody can prepare something to say about that topic in tutorial. So then we come to the tutorial together and then we look at these questions together so that all of us can contribute in answering the question and learn from one another. Alright? So I believe that's much more better than me coming here presenting to you what I have in my PowerPoint, right? Because I think this course is more theoretical, right? So yeah, it's practical, but teaching it in class seems a bit theoretical as it were. So if we discuss more instead of me teaching, I think we gain more. I want to believe that. Alright, so that's why I want to go with the approach of we all discussing. Alright, so for today, I'll just go through the function, structure, and then the business model of the Asian private banking and wealth management industry. So for the assessment, these are the things that we have for assessment. We normally have group projects, but for this year, Donnie said he wasn't going to do a group project. As at the last time I spoke with him about group projects, it was like he doesn't want to do group project because of the large class, right? Because the class is large, so he doesn't want to do group project. So there won't be group projects this year. What will you have will be assignments, and he said he might increase the assignment to 3. Right? Normally we do 2 assignments for students for the course, but you might have 3 assignments, and then you have midterm test, and then the final exam. The midterm mostly it's objective, right? MCQ, I mean. Right. So for the final exam, mostly MCQ, but then I think we have like the theory part to final exam or something. Okay, so and then this is textbook for the entire textbook. In case you want a copy, you can go through this link and then get the copy from the library. Alright? But if you go through the slides, tutorial and the lecture slides, I don't think you actually need the textbook. Alright? But if you still want to read the textbook, just go to the library and get the textbook through this link. Right? So wealth management and asset management. Right? Basically, asset management it's a broader term. Alright? And then wealth management is a subset of asset management. Right? So management of assets. Asset means everything that an individual owns. Wealth means you're managing the wealth of the individual. Basically, this it's more applicable to high net worth individual, right? But this is not necessarily only high net worth individual. It applies to everybody as long as you have something to manage, right? So that's that about that. And then the traditional investment and then the alternative investment. Traditional investment is just everything that we know as investments that we can invest in, right? From stock to real estate part of it, and then still commodity, right? But the alternative investment made primarily is just a way. So, example of alternative investment would be something like option, future, um, um, option, future, commodities, right? And then what else? Anything you can use structured products, yeah, structured products, right? So structured products are products that you can use to hedge against inflation and other things like that. So those are the major things we have under alternative investments. But of course, we still include, where we have the private equity, we have the real estate, we still have the commodity as we have here. But this is more of things you use in hedging against inflation and beating the inflation rate, something like that. So that's the primary difference between the traditional investment and the alternative investment. And of course, okay, some points also, some salient points also I mentioned. For example, some asset class are illiquid. Of course, for example, commodity, right? Commodity is a bit illiquid, right? There's not a ready market for commodity as well. It's not something you can sell at a snap of a finger. And also real estate compared to say stock. Also private equity is not something you can convert to cash easily, right? Most private equity you invest for over 5 years to 10 years, right? So but then if you invest, for example, in a publicly traded company, you can of course sell your stock anytime you want on the exchange you are using, right? The platform you are using. So that's the major difference between the alternative investment and the traditional investment for this slide. So then we have the retail wealth management and then the private wealth management or private banking, right? So retail wealth management is more of a generalized approach to wealth management, right? Whereby this is more of a bank, okay, like a section within a banking industry. Why this is more secluded to particular individuals, which are the high net worth individuals. And this is the reason why you have a relationship manager handling 1 to 200 clients, whereby here a relationship manager will handle only 25 to 30 individuals, because this is more individualized, while this is more generalized. I think that's the major difference that we have here. And then here, mainly the investment in equity bonds fund according to a simple risk portfolio questionnaire. While here, the asset allocation are based on the expected result and expected risk. So this, for like I said, more for the high net worth individual, and these are for individuals that are upcoming high net worth individual, right? They are millionaire, right? These probably they are basically a billionaire, all right? So this is more personalized or individualized, and this can be more generalized. That's the major difference. Okay. And apart from being individualized, all right, so the needs of these people here are much more diverse compared to the need of the people here, right? The people here, basically, most of what they will need will be to just want to grow their wealth, right? How to grow their wealth. While people here, they want to grow their wealth. Some of them still want to grow their wealth. Some of them are looking into retirement planning. Some of them are looking into succession planning, right? So it depends on the area where they actually want to, they are to focus on. Okay, so this is why it is more individualized and this is more generalized. Yeah. So yeah, for the two, we can actually have insurance products, not only for these people, but these are more of insurance. Okay, this part do want insurance, but also these people can need insurance. Right? They also might want to, of course, protect themselves against unforeseen contingencies, right? Like death of the individual. So these people also can also have the need for insurance products. But whatever the case, the most important thing you need to know here is that this is So I'm sure you've seen this already. So this is just the breakdown of the people that can be served in private banking and asset wealth management. Right. So we have the high net worth individual, we have the middle tier, and then we have the ultra high net worth individual. The ultra high net worth individual are the people with over 30 million USD. Right. So and of course from here, this can be served with the retail banking, and this can be either retail banking or more individualized asset management or wealth management personnel. And of course, this will be more of asset management personnel. So that's that. So the business model generally just talk about how does the asset management personnel or asset management people actually make their money. How do we actually make money, right? So depending on the services that they are offering, okay, so we have the some who are just investment house or brokerage, something like we have the Morgan Stanley, the Goldman Sachs, and then they are investment oriented and stronger security service. Then we also have the external asset manager or the independent financial advisor, and here also we have the multi-family office, right? And they operate as third party manager without holding the cash. So they have a custodian that hold the client's assets. They are not the one who hold the client assets directly. They have a custodian, and then they offer tailor-made services to the client. And also we have the insurance and wealth management. So for me, this is the area where I actually participated, right? So when I finished my master's degree here in Hong Kong, I worked with AXA Insurance, right? And then before coming to HKU to teach, so I do more of insurance and wealth management. So I work as a financial advisor, right? So help clients to manage their money, right? So basically, I work with the experts here in Hong Kong, right? So not the high net worth individual. So I am more of generalized financial advisor, right? Than working with someone who has a lot of money to invest or to put whatever, right? So under the wealth management banking model, the financial advisor provides expertise and guidance to affluent clients, right? So they provide the services to affluent clients, and then they charge their fee. And the way they charge their fee could be through hourly rate, annual fee, and then commission, all right? While some of them can use a combination of a hybrid, we call it a hybrid approach, a combination of some of these way of earning money. And for the wealth management business, characterized by not just financial advice, so depending on the need of the client, that's how they offer their service. So that's what the business model here is talking about. So for the wealth life cycle, so the wealth life cycle, just telling us what are the key things that a wealth management individual can actually offer to their client. And depending on the need of the client, right, we determine where the financial advisor or the relationship manager will place the client to begin the service that the client will, the relationship manager will be offering to the client, right? So depending whether the client is at the point where he wants to actually create wealth, or whether the point where he wants to manage his wealth, or whether he wants to transfer his wealth. The most important thing is that after conducting two things. First, know your client. Okay, so the relationship manager wants to know the client very well first, such that you'll be able to determine what is the goal of the client. Alright, so after determining the goal of the client, then it will be able to determine where to place the client, whether he wants to grow it for his wealth, or make more money, or just manage what he has, or transfer his wealth from himself to his succession, right? So So the relationship manager will then determine which vehicle will be best for the individual. For example, if it is transfer of wealth, how does the individual really want his wealth to be transferred? Does he want to actually pass all his wealth to the children, or he wants to pass all his wealth to say there is a next of kin who is not actually part of the children? Okay, he wants to like split it, or does he want to give it to the government, something like that, or he wants to do like a charity? So depending on what the client wants here will determine how the relationship manager will deal with the client. So same thing, still just another way to see what to do as relationship manager or wealth manager. Alright, so you see wealth creation, wealth management, and wealth preservation, right? And then different kinds of activity that are involved in each of the stages where an individual, a wealthy individual, can be. Then we have the income, household management, and business overview. Right, so this data is more of 2021. Okay, so that's what I could lay my hands on for now. Probably if you check well, I have the link, okay, at the end of the slides. Right, so if you want to check more, you can see the link here. You can still read more about the survey and other things. But then for what I have here is an asset management and wealth management business in Hong Kong. The AUM, okay, AUM increased from 4 billion to increase year on year to this, okay, 35 billion. I think this is Hong Kong dollar and this is US dollar, right? So from 2021 there's a 2% increase, and then from 2020 to 2021 there's a 2% increase. Alright, so and then the AUM of asset management and fund advisor. So the paper or the survey now try to split these funds that are managed to different kind of individuals or different kind of relationship manager or different kind of maybe fund house or the like insurance company, banking sector, and the multifamily offices. Right. So here we have the asset management and the fund advisory business, and then we have the private banking and the private wealth manager, and then we have assets held under trust. Right. So these are different say products. Right. These are the asset manager, these are the private banking, the banking sector, and these are trust. Right. So then we have the AUM under each of these products. Okay, we can put that with each of these products. So the AUM under asset management as at 2021 is 3 billion. For private banking, okay, it's 1.3, and then for in trust, okay, we have 4.7. Right. So those are the different products that we have, and then the net fund inflow, okay, to all these three products that we have in Hong Kong is 2.1 billion, all right, as opposed to 2 billion in 2021. So there's a 6% increase compared to 2020, and asset source from non-Hong Kong investors. So we have 60% increase of the AUM, that is people who are not Hong Kong locals, right, who are actually investing in Hong Kong or putting their wealth in Hong Kong. That increase from 2020 to 2021 to be 65%. Then assets managed in Hong Kong, so the total assets that are actually managed in Hong Kong also increased. So assets managed in Hong Kong made up of 56% of the AUM of the assets management business, with 49% of these assets invested in equity. So most of the assets managed in Hong Kong, most of them are actually invested in equity. As of then, all right, now as of last year, 2023, we know that Hong Kong equity market is not performing well. All right, so we are not sure what the data is going to be now. Probably they will have moved more of that how equity in Hong Kong into some other then the staff of the asset wealth management in Hong Kong increased also by 12% compared to 2021 to 54,000 individuals. And the Hong Kong domicile SFC authorized fund. So there are authorized fund by SFC, there are registered open fund companies, and then there are LC. Okay, the LC type 9 regulatory activities, and then the mainland related LC, those ones that are probably have an affiliate with a company in mainland. Alright, so those are the staff in each of these registered companies or something like that. So, and then the amount of money under management for each of them. So, for example, as at 31st December 2021, the number of Hong Kong domicile SFC authorized funds increased by 7% year-on-year to 865, right? And then their net assets valued increased by 5%. So the number increased to this by 7%, and then the asset under management increased by 5% to 192 billion USD, right? Something like that. So that's just an example, and for the other ones also. So it talks about the staff and then the asset under management for each of these types of companies. So that's that. Yeah, so that's for the Hong Kong wealth management industry. Right. So if you want to read more about that, you can just go through any of the 4 links here to read. Have more look into that. Okay, so then we have the wealth management investment process. So, like I said, for this process, the first thing that a wealth manager wants to do is to know at which point or which one is much more relevant to the client as at the time he is onboarding the client. Right? And how do we know this? The best way to know, of course, is to do KYC. Alright, so for us in the insurance company, what we do is that we do KYC first, and then we do the need analysis. So the need analysis help us in conjunction with the KYC to know much more about the client, so that we can know what we need to offer the client. Right? So we do protection and then wealth management. Right? Which protection talks about insurance, and then wealth management talks about increasing of wealth or whatever. Right? So sometimes we also help with tax planning. Right? So for example, if someone wants to pass his wealth to his say younger generations, there are best ways that you could do that, such that most of the wealth being passed as to in succession planning doesn't go into tax, right? And one way to do that is to buy probably life insurance, right? So if you put the money in bank and you say, oh, okay, a will, right? So there are 3 basic ways whereby funds can be passed to younger generations. You can either write a will, okay, or put the money in a trust, or you can do life insurance and make the person you want to be the person who has the fund to be the beneficiary. Right? For a will, the tax is higher. Trust comes second for when it comes to tax. Alright, but life insurance is a bit more conservative when it comes about tax paying. Right? So that's why for an insurance company, when we want to help the individual, okay, we want to know what is the long-term goal of the individual. Do you intend to actually pass this wealth to your younger ones, or you just want institution whereby after you are dead, you want to give half of it to charity, half of it or some of it to government, and then some of it to your kids or children, something like that. So you want to understand what exactly is the long-term goal of the client, and then also the immediate goal of the client. So these two together will then give us an understanding of which product do we actually want to offer the client. And aside from that, we also want to know the risk profile of the individual. Right? What is he looking for, or what is his risk level? Okay, what is the amount of risk that he's willing to bear, right, to earn the return he wants, or to achieve the goal that he's setting for himself. Right. So the KYC helps in the risk and return profile, to know the risk and return profile. While the need analysis helps in knowing the or balancing of the short-term and the long-term goal of the client. So going with the risk profile, the return profile, and the short and long-term goal of the individual will then determine which area will place the client in this cycle, all right, and then determine the product that we offer to the client. So something like that. That's how we do. So for here, the first thing will be the client goal setting. So like I said, we want to know what is the immediate and the future goal of the client, right? Whichever thing the client wants to achieve in the immediate future and in the long-term future will determine how we address the need of the client. So we do the client profile, and like I said, the goal for the risk level of the client. So there's something we refer to as risk tolerance, all right? The risk tolerance is just the psychological or the emotional capacity of an individual to bear loss. Okay, that's what, in my own term, that's how you can define risk tolerance, the emotional or psychological capacity of an individual to bear loss. Okay, so goals and objectives must be consistent with an investor's risk tolerance. Right? That is, an investment objective or agreed upon investment goal should not require more risk than an investor can reasonably bear. So that's that. And then some investors also determine their goals not only in quantitative terms. All right. Some of them also use qualitative, right? Children education, a better life, something like that. Alright, some of them will say, oh, what I just need is to beat the inflation. Alright, I am wealthy. Alright, what I just want to do is that I want to make sure my wealth is not susceptible to inflation. Okay, so I want to maintain a return whereby I am earning something which is way over above the inflation rate, and that's that. Why some people will tell you, no, I just want something like, say they set a particular goal, say I want 12% increase per year, return per year, something like that. So depending on but whichever way it is the duty of the relationship or wealth manager to help that individual balance his goal with his risk profile, and then the immediate and long-term return. Okay, so when we are doing this, we consider the risk tolerance, and also there is also something else which is risk capacity. So risk tolerance, okay, so it's like, for me, I say it is the psychological or emotional capacity that an individual has to actually bear loss. So but here is determined as the level of market volatility that a client may find most uncomfortable, but he or she will not call the wealth manager and say, I can't bear this stand anymore, I want to sell out. Right, so that's that. And when we consider this, there will be somewhere where there will be a conflict between risk capacity and risk tolerance. Risk capacity is actually the amount of wealth or asset the individual has that he can risk in the market. Okay, the level of or the amount of wealth the individual has to risk in the market. Okay, so although the risk tolerance, commonly referred to as an investor's emotional tolerance for volatility or suffering a loss, it is also important to understand the client's capacity, risk capacity, which is the financial capacity to withstand market loss. All right, so this is basically the amount of money a client has to risk in the market. Right, saying I have 100,000 or 100,000. Or 1 billion or something, right? But my risk capacity, my risk tolerance is 3%. But you have a lot of money, so you should be able to bear more risk because your risk capacity is higher. Okay. So then we say that they need not be the same. That is, risk capacity and risk tolerance shouldn't have to be the same. But when an investor's risk tolerance exceeds his or her risk capacity, then the lower risk capacity should prevail, and the wealth manager needs to educate the client that client's financial capacity to withstand loss. All right. So if there is lower risk capacity, if the client doesn't have a lot of money or that he can afford to lose in the market, but he has high appetite for risk, because of course he has high appetite for return, then we need to educate the client that you actually don't have a lot of money to risk in the market, so you can't be aiming for a high return when what you have is not that much. Right, so the risk capacity prevail. But then if the risk capacity exceeds the risk tolerance, then resolution is also needed. In this case, when market losses exceed a client's risk tolerance level, then a nervous client is likely to bail out of the market independent of his or her risk capacity. Right, even though in this case, all right, the individual has more money to actually play with, or which he can afford to lose in the market, but then his risk tolerance is low. Okay, he doesn't have the psychological or emotional ability to withstand the risk. All right. So in this case, the wealth manager needs to actually educate the client that, oh, you have more ability to actually risk some of your money so that you can earn high return, even though your risk tolerance is low. Right, you actually can increase your risk tolerance and earn more money. So that's the way to help clients in addressing their goals and their risk capacity and return, or balancing their goals, risk capacity and return, or risk tolerance. Right, and then we have behavioral bias. Okay, so for behavioral bias, what do we mean by behavioral bias? Behavioral bias is just a situation in which as human being, all right, we prefer certain gain to uncertain gain, and we prefer uncertain loss to certain loss. All right, so that's what behavioral bias means. Okay, so standard finance theory suggests investors prefer certain gain to uncertain gain. All else being equal, all investors are risk averse. All right, so every individual actually wants to run away from risk, even though the individual that says, yes, I want a lot higher return. Okay, the investor might want, let's say, 20% return, but truly it doesn't want 20% risk. And of course, in the world of investment, the higher the return, the higher the risk. All right, but normally every individual are risk averse. Right, so then loss experiments suggest that most people prefer uncertain loss to certain loss. So we prefer certain gain to uncertain gain, but we prefer uncertain loss to certain loss. If I tell you that, oh, if you invest in this, it's going to go down, I'm sure the investment is going to go down by say 45%. Okay, but you have a chance of 25% that the investment is going to be fine. You want to bail out because you will just be thinking of the certain loss. Oh, this is 25%, so I don't want, 45% loss, so I don't want to risk my hard-earned money, something like that. So everybody would prefer gain that we are certain of, and we prefer a loss that we are uncertain about. Right? So that's that about behavioral bias. So I think here, this phenomenon is called loss aversion, right? Investors are reluctant to take risk for gain, but we take risk to avoid loss. So we call that loss aversion. So it is a behavioral bias that affects investors' reactions to risk, and hence can affect asset allocation. Right? So when we are doing asset allocation also, or we are trying to help the client to achieve its goal, we need to put into consideration the behavioral bias of the individual, right? And this is going to affect asset allocation, right? So it can manifest itself as a negative emotional impact of realizing an investment loss, thereby making it difficult for an investor to actually cut loss. So some people, because all they are thinking about is the gain, all right, even though their investment is going down, they still believe that, oh wait, don't sell off yet. And as a relationship manager or wealth manager, you know that this investment is not going to actually yield this client anything in the nearest future, why don't you get out of this position and then let us invest this money in another product or something like that? But because of its kind of own way of thinking of loss aversion, right? It's just chasing the return, chasing the return, chasing the return, even though its investment is going down. Right? While some people they just have a little bit of negative results, or a little bit of that their investment is going down just a little bit. They want to get out of the position quickly, even though what they should do is to wait, right? Probably, for example, let's say an individual investors like all of us, all right? Say you invest in a large cap company. A large cap company is a company that has like say 10 billion capitalization. So this type, for example, let's say you invest in Google, okay, in 2019, okay. You know Google is a large cap company, and in 2020 COVID happened. Now because of COVID, almost every company went down, all right. Their return went down. Then because of that, you want to get out of the position because you are afraid that you don't want your money to go down the drain some more. All right. At that point in time, if you have a relationship manager that you are working with or a wealth manager you are working with, I'm sure the wealth manager will just say wait a little bit because this is a large cap company. It has a higher chance of rebounding. Okay, it can recoup or it can give you what you want in the nearest future, right? Than if you invested in a small company, let's say a small startup company, and then COVID happened. All right. At that point in time, the best thing anybody could have done is to get out of investment in a small cap company. All right, because the possibility that that small cap company is going to revive, okay, and then give you the return you want in the near future is very low. So something like that. So that's where the risk aversion comes in, and how the wealth manager needs to relate with the client. Then also we have next thing to consider is the client constraint. What do we mean by client constraint? There are different kind of constraints. We have time horizon, we have the priority of the client, and then the liquidity requirement of the client, and then the legal consideration, we have taxes, and then the unique circumstances of the client. So these are all the things that should be also be considered in determining asset allocation of our clients. All right. So for private clients, typically have a multi-stage investment horizon. So we have the time horizon. Clients can accept risk for long-term horizon, and then the liquidity need. Okay. Liquidity need of the client also needs to be considered. The ability to convert the cash to prevailing at the prevailing market prices. This is the marketability of the asset class we are actually investing in should be correlated with the client's objective or the client's goal. Okay, so if the client will need say a large amount of cash in the not this too distant future, we do not want to invest in an asset class that is not easily to convert to cash. Right? We want to invest in an asset class that we can easily convert the assets to liquid cash, such that the client can use his liquid cash for whatever he wants to use it for, and then it will not be too late. So something about liquidity. Right. So another thing to consider is the life balance sheet of the client. So we want to consider at which stage, what is the client's asset and what is the client's liability, and when will the liability be due. Right. So mortgage of the client, the client needs to pay for the college of his children, stuff like that. We want to know when will that be, and how can we actually structure your portfolio such that it can accommodate your goal in the not distant future based on your life balance sheet. Alright, so that should be another thing to consider, the life balance sheet of the consumer, which consists of the assets of the individual, the liability of the individual, and then the discretionary wealth. Right? So the discretionary wealth will be how much the clients actually have. Okay, after the deduction of his liability has been done from all his assets, then he has the discretionary wealth. So our planning should basically be based on this and not on the assets that he has. Alright? So the asset allocation that we will then do will be based on the discretionary wealth and not on only the assets that he has. Right, so some things to know about goal setting. So we have hidden goal, which are emergency reserve, and then insurance coverage. So for hidden goals, these are the things that we should also put into consideration, even though they are not brought to the forefront. Everybody will need coverage as a profession at a point in time. So it's good, always good to have a protection plan into the wealth management plan that we are having for our clients, and also have some reserve, cash in reserve, or some things that can be easily converted into cash, just in case there is an emergency for the client. Right? Then non-investment or short-term goals. These are also another things that we need to put into consideration, where, for example, market volatility will result in period of loss. So no investment should be considered unless the time horizon for the fund in question is at 5 years. That is roughly an economic cycle. So here, if the market at the point where the client approaches us is very volatile. That is, the market is actually going down, but the client is saying that I really want a big return. So we should consider when will the client actually need the money, alright, something like that. So because whatever we want to invest in at this point in time, when the market is not too good, it must be a long-term perspective investment. Alright, you can't do a 2-3 years perspective investment when things are not really going too well. And then we should expect that the client will be happy at the end of the day with the result that is going to be yielded for him. Right. For funds needed in less than 5 years, key criteria is liquidity. Right. So criteria is liquidity. If the client will need the cash or need a lot of cash or a lot of fund in less than 5 years. Another thing, intermediate goals. So e.g. the children university, education, welding, second home, trips like that. And then another one is life goal. Right. So these are the type of goals that we have. We have the hidden goals, we have the non-investment or short-term goals, we have the intermediate goals, and then we have the lifetime goals. Right. So financial independence and then living expenses classes. Right. So those are the goals that we could set with our client. Then another way to look at it is that whether the client has ongoing expenses, ongoing increasing expenses, right? But probably right now the client is, for example, paying a loan, all right, and then the loan is increasing rate loan, whereby what is paying right now is lower. Okay, the repayment plan increases as it pays the loan back. Okay, maybe now it's paying, let's say, 2% of the loan back, and then in the next, say, 2-3 years, it's going to be paying like 5% back. All right, so we need to put that into our consideration also. Then limited or duration level expenses, which are fixed and terminal. All right, depending on which type of expenses the client might have or is having. Right, some expenses are ongoing, while some are just at one point. Right, so ongoing terminates before client's death, e.g. home mortgage. So this will be fixed and terminal expenses, while this is an ongoing expenses. So like, for example, permanent or non-inflatable, like I said, payment of loan. And then another one is limited, which is duration increasing expenses. Okay, I think I mentioned this also, whereby the expenses of clients keep increasing as time goes on, year on year. Alright, some are terminal, some are continuous, and some are continuous, but still it increases as time goes on. So all of these should be planned into the client's goal. So another one is the risk objective. So the risk objective here is just that some clients prefer to define risk expressed dollar loss amount rather than technical or statistical term. Right? For example, some companies may define their risk in terms of standard deviation. Of course, what the client understand is just that, oh, tell me, how much percent will is it likely that I lose in this investment if I put my money in this investment, right? So, for example, another firm might have that kind of risk definition or risk objective. So, depending on whatever the client prefer, that's what will determine how we should actually define the risk to the client, right? So, and way instead of using that as standard deviation, another way that, for example, someone can or a relationship manager can tell a client of the risk involved in the asset that he is planning to invest in with a financial frame may determine an asset has 3% 1 month VAR variance, okay, of 2%. Then what this means is that a 3% chances of the asset declining in value by 2% during a 1 month time frame. Do you understand that? So it means that there's a possibility that this investment decreases in 3%. Okay, there's a 3% chance that this investment decreases by 2% during a 1 month time frame. So something like that. Than just telling the standard deviation of. So some people do not understand standard deviation, high level. Of course, they actually do. Most of them do not. What they care about is okay, how many percentage? Tell me in terms of percentage, not variance or standard deviation. Right. So that's that. Yeah. Any question? Any questions so far? Alright, so for those who came late, what I said at the beginning of the tutorial is that as from next tutorial, what we'll be doing is more of discussion, alright, among between ourselves, right? So such that each of us can learn from one another, right? So and to facilitate that, it will be better for us to have the things we want to talk about before we come to tutorial for that day. So each person should endeavor to actually put in here a default course forum. If you have a question or you have a topic you want us to talk about, right? Probably it's not clear to you, or it's clear, you just want to have discussion around this, okay, this topic. Just put it here in the discussion forum so that everybody can see it, and then people can prepare to talk about that in the next tutorial. Alright? So I might also put some topic in there also that you need to look at so that we can talk about that in the next tutorial. And also, tutorial is not compulsory, right? If you do not want to come, welcome not to come. Alright? So because there is no mark attached to tutorial. Okay? So the next time we meet will be the week after Chinese New Year. Alright? See you then and have a great Chinese New Year break. Gone if I jump.